Hi, good afternoon. My name is Ramendra Bhatia, and on behalf of ASK Investment Managers, I welcome you all to ASK Financial Opportunities Portfolios quarterly update call. Today, we have with us Mr. Bhavesh Kanani. Mr. Bhavesh Kanani, Portfolio Manager, has an overall experience of 19 years in equity research spanning global and domestic markets. His domain expertise is in BFSI, banking and financial services industry. Prior to joining ASK, he has worked with Centrum Broking, Sharekhan, Bank of America, and Citigroup. Mr. Kanani is an MBA Finance from IBS Mumbai. He has been with ASK since 2013. Today, we have scheduled this webinar where I would request Bhavesh to cover the broader trends in the market for 10-15 minutes, followed by a deeper understanding of the ASK Financial Opportunities portfolio, giving an insight on what happened till now in financial year 25, where do we stand now, and how we see things going forward. This would be followed by Q&A. I would request all participants to type in your questions and queries related to the portfolio, and we shall curate and try to get them answered. So Bhavesh, thank you so much for joining, and all over to you.
I'll just share the screen. Let me know when the screen is visible.
Yeah, it's visible.
Okay. Well, thank you, all the participants. Let's dive into some important trends we saw related to the result and what is happening at industry level. To begin with, we'll talk about trends related to banks. Firstly, the credit growth itself. Now, last year, we closed the year with about 16% credit growth, and since then, the growth has moderated down to 14%, right? And if we see the segments within the credit growth, we can see that industry credit, that is large, mid, and small corporates, the growth continues to remain in high single digits and is weakest among all the segments. Whereas all the three other segments, retail, services, and agriculture, are doing relatively better. Uh, kind of uh, diving in a little more deeper, if we look at product level growth rates, this is the industry growth of 14%. There are segments which have grown less than 14%, and some segments, as we discussed, retail, agri, MSME, housing, and gold have reported better growth. Uh, Moving on to the company level performance versus 14% growth for the industry, we saw most of the leading banks reporting significantly higher growth than 14, whereas there was growth challenge in HDFC Bank as well as Bank of Baroda. We can take up HDFC Bank's specific performance separately during the Q&A session. In line with the larger trend at industry level, at company level as well, we saw that unsecured loan growth, that is personal loan, credit card, and microfinance loans, the growth has seen moderation. These segments, while they are being labeled as unsecured, they are also yielding much higher spreads or yields compared to other segments like housing, which are secured. So, as the growth in these unsecured products has come off, it has also impacted NIM to an extent, which we'll discuss later on during the presentation. Uh, on deposit growth, FYTD, that is from 31st of March, basically the system has not grown at all. It is remaining at the same base level, whereas CASA has actually declined for the system. because money is moving from CASA to term deposits, because term deposit rates continue to remain attractive, and we have seen banks hiking rates at the shorter end of the maturity. Uh, Within the banks, we can clearly see that IndusInd Bank and ICICI Bank have delivered better growth relative to the system. And in terms of CASA market share, we can see that there has been stability for some entities and decline for others. Only two entities have reported CASA market share, which is HDFC Bank and ICICI Bank. Interest rate environment, uh, at system level, the liquidity deficit decreased, allowing some breathing room to the system. Earlier, as you can see, liquidity was in deep deficit right through this calendar year. But in recent months, the deficit level of deficit has gone down, although it is still not in surplus. As a result, the average call rate hovered around 6.5%, which is closer to the policy rate prevailing in India. Uh, Now, given the trend in inflation and RBI's commentary, there is anticipation that rates have peaked out, and there will be cut in policy rates a few months down the line. In line with that expectation, banks have resorted to raising money through short-term certificate of deposits. As we can see in last a few years, comparison is clearly saying that the amount of CDs raised by banks have gone up. Interest rate environment from perspective of term deposit rates, we can see that a lot of banks have hiked their rates, the peak TD rates in less than 1 year bucket. Whereas when we look at higher maturities, that is 3 year plus, there are only fewer instances where we have seen hike, and the extent of hike is also limited to 20-25 basis points. So in essence, the liquidity is still tight. Deposit growth is still trailing the credit growth, although credit growth has moderated. In terms of operating efficiency, this dark blue bar represents the revenue growth, and in context, what is the OPEX growth? As we can see, for some banks, the total revenue growth was higher than the OPEX growth, and thus we saw operating leverage benefits in these entities. Whereas in banks like IndusInd Bank and Kotak Bank, OPEX growth was higher than revenue growth. Another measure of operating efficiency is cost to assets, which is represented by this exhibit here. For most of the entities, we can see that cost to average assets has improved except for ICICI Bank in the Q1. Asset quality, which is probably the most important monitorable at this stage. What we have essentially seen is that versus Q4, the gross slippage rate, or gross slippage rate is nothing but the extent to which there is formation of new NPAs. Across the sector, you will observe that versus Q4, represented by the orange bar here, the Q1 level is higher. However, versus the year-on-year level, the gross slippage rate for most of the entities is lower. And equally important is the amount of upgrades and recoveries experienced by the banks in the NPA pool. Here we can see that as a combination upgrades and recovery, the salience has been coming down across the sector. Put together, rising gross slippage rate and easing upgrades and recovery essentially mean that net slippage ratio, that is rate at which the GNPA increases, goes up. to an extent, which is slightly visible when we look at this exhibit, where we are talking about the total GNPA, which for many entities has gone up on sequential basis, represented by this orange dots. However, the situation is still not very concerning, largely driven by the fact that GNPA is still lower than what it was a year ago. Moreover, the level of provisioning coverage ratio held by all the banks is above 70%, which is a source of comfort. Over and above this NPA provisions, there are few leading banks who have created a lot of contingency buffer. So as NPA increase in future, banks like HDFC, ICICI, Axis, and to an extent IndusInd have reasonable provisioning buffer over and above the PCR to help and manage the rise in NPA as we go ahead. Credit costs, as we have been highlighting, for most entities, the credit cost has gone up. Probably HDFC Bank here again is an outlier because of various reasons. In 24, the increase was led by the merger impact, and so not necessarily comparable with the FY23 data. So in case of most banks, credit cost has already begun to inch up as it normalizes upwards. Uh, the uh, uh, the overall picture of asset quality, while remains still healthy, although credit cost has begun to inch up. Some key areas worth noting where pain has been slightly more pronounced is the microfinance business. Here we have gathered data of microfinance entities as well as the ratio available for microfinance bank for entities like IndusInd and Bandhan. As we can see, Q1 25 data indicates that microfinance portfolio of all these entities has seen dramatic rise in stage 3 or GNPA levels. The other area within retail, if you look at the delinquency levels, March 24 delinquency levels have been better for housing, property loan, and auto loan, whereas for personal loan and credit card, delinquency levels have already begun to rise. Overall, because of NIM compression and upward movement in credit cost, for a large part of the banks, we have seen ROAs and ROEs coming off. Uh, and except for Bank of Baroda here, all of them have experienced around 10 to 20 basis points decline in ROA and around 200 basis points decline on an average in case of ROE. In case of NBFCs, the growth, AUM growth was higher than what we have seen for the banking system, 14% growth. Within the pack of NBFCs that we track, we can see that the growth for microfinance entities was higher despite the asset quality related challenges. And for affordable housing finance companies too, the growth remained upwards of 20%. Within the diversified NBFCs, all across entities, we can see that the growth rate has moderated versus Q4 24, but still remains pretty healthy, except for a Power Finance Corporation. Compared to the AUM growth, the NI growth across NBFCs in most cases was lower. There are specific cases like REC, PFC, and microfinance entities where the NI growth was higher than the AUM growth, largely driven by the fact that they have experienced stable to declining cost of funds, whereas yields have gone up. In case of India Shelter, they have benefit of the IPO proceeds, which is helping them contain borrowing in the near term, and hence higher NII growth compared to AUM growth. This is another comparison of the NBFC space where we are comparing AUM growth, NII, PPP, and PAT growth. As you can see that the AUM growth for most entities has not necessarily translated into equal growth in the bottom line. Especially the microfinance entities have seen a dramatic decline in their profitability, while AUM growth remains pretty healthy. And same is also visible in pre-provisioning profit growth. But when we look at bottom line growth, because they saw a sharp spike in GNPA, they had to provide more, and as a result, Fusion reported a loss, whereas Pandana saw 53% decline in profitability. Except for credit access, all of them have seen decline in bottom line. In comparison, affordable housing finance players, all of them have reported very strong bottom line growth as well as AUM growth. On life insurance front, more or less the trends we had discussed last quarter continue to prevail. We have seen AP growth being pretty reasonable with minimum growth of 20% across the leading players. However, this growth was driven by ULIP as a segment, which is typically a low margin product. And as a result, across entities, you will observe that the VNB margin has been falling with the sharpest fall experienced by ICICI Prudential, largely because of the product mix. There have been few regulatory changes in life insurance. One being the most important being surrounding the surrender value charges, where IRDA's revised guidelines would require insurance to give more money back to the policy holder in event a policy holder decides to surrender the policy for non-par products. Within non-lending financials, the performance was very impressive. I would rather say that in case of banks, the performance was weak or tepid. In case of NBFCs, the performance was mixed with some entities doing better than the others. Whereas when we talk about non-lending financials, most entities associated with capital market posted very impressive results. As can be seen here in terms of revenue as well as bottom line growth, whether it is wealth managers, AMCs, or RTAs, the growth has been pretty high for all of them. Even more impressive is the performance of exchanges, whereas rating agencies continue to struggle right from the revenue growth line perspective as well, because of the fact that for entities like CRISIL, international operations form a sizable chunk, and that is the area where the growth has taken a hit because for CRISIL, most of the clients happen to be on the large banks or investment banking houses based out of US or Europe. And they are witnessing business challenges of their own. And as a result, they have curtailed spending, discretionary spending, which typically was served by entities like CRISIL, and hence a slowdown in the business performance. At portfolio level, FOP has delivered a sales growth of 23%, and more or less that is translated into similar kind of bottom line growth. This is significantly better than the uh, growth performance delivered by Nifty 50 as a pack. This is the broad distribution of the portfolio. As you can see, we have significantly increased our exposure to the non-lending businesses, which includes exchanges, RTAs, rating, and insurance as well. In terms of the operating environment, as we were discussing earlier, interest rate cut is something that is getting built up into the expectation now, largely because of the fact that growth continues to remain strong, and the outlook for growth as well is quite upbeat, as reflected by the 50 basis point upward revision by IMF for FY25 GDP growth estimates. Whereas, domestic inflation projections were lowered by 20 basis points to 4.6. So this combination, along with the fact that most recent budget targets to further reduce the fiscal deficit, should create right environment for RBI to start cutting rates somewhere during the end of the current year. Equally important aspect is rainfall, because this tends to affect inflation as well as rural cash flows. So far, whatever deficit we saw in the month of June has been, kind of made up in the remaining part of the monsoon, uh, and La Nina conditions are expected to persist. Uh, and A normal monsoon would essentially help us maintain inflation within the tolerable range set by RBI, that is 4 to 5%, and it will support rural cash flows, which has been one of the areas of concern when it comes to performance of a lot of these companies who are serving or present in rural areas. Overall, some of the aspect that I kind of wanted to highlight in terms of the macro and micro factors at play these days. We have seen the outcome of election and continuity of power, although with a lesser majority, still lends credence to policy and fiscal stability. We've already seen the first budget from the ruling party, and that continues to follow fiscal discipline. The macro trends as well as the outcome of election has kind of guided the current government to focus more on job creation and consumption, and that is visible in some of the steps they've taken. In general, macro remains strong with GDP growth of 8.2 in 24, and then expectation of around 7% kind of growth in 25. Inflation has eased and in reasonable control, and current account, fiscal deficit, and currency are all stable or improving. Corporate performance too was strong for 24, and for FY25 and 26, the expectation is of a 14 to 15% bottom line growth for the Nifty 50 pack. With that, I end my part of the discourse. Now we can open the floor for Q&A.
Participant, I would request you all to type in your questions and queries related to the portfolio, and we shall curate and try to get them answered. Bhavesh, there is a lot of interest building up with multiple questions already been raised. First is the banking as a space is expected to have margin pressure as we are seeing deposit rates going up. How are we positioning our portfolio with this in mind?
Okay. So we have discussed this point in our earlier conversations as well. Yes, margin for all the banks have seen pressure. The pressure was most visible 2, 3 quarters back when margins peaked out and they started coming off. Incrementally, the lending rates are not going up, and whatever cost of fund pressure we have seen is largely because of some tinkering done by banks on the peak term deposit rate. So I would put it this way, that worst part of the margin compression is behind us. incrementally, margins will hover around the levels we have seen in Q1 25. In terms of NII growth, what happens is, let's say margin were at 100 in the year ago quarter, and today they are at, let's say, 70. Incrementally, even if it remains at 70, year-on-year comparison is still unfavorable. But 2-3 quarters hence, margin will appear to start looking flat, and probably that is when we should see first round of impact coming because of policy rate hikes. Now, how repo rate hike will impact all the banks, repo rate cut will impact all the banks is most banks have 50% of their book which is linked with repo rate. And as in when repo rates will be cut, the lending rates will also come down, whereas deposit rate cuts will take time to kind of reflect in the financials. So the picture for next 1-2 years on margin front is that worst of the decline is behind, but margin will still remain under pressure because of one policy rate cuts and the fact that liquidity in short term continues to remain tight. Uh, and given that this was the very expectation we had in mind, we had kept our exposure to banks significantly lower than what it is for, let's say, BSE Finance. We have been cutting down exposures incrementally and moving a lot of weight to non-lending financials, which is not necessarily connected with the interest rate cycle. Most of the plays on non-lending side, as you would observe, are directly or indirectly related to the saving story of India. And so that is how we are trying to manage the interest rate risk on the financial services sector.
Okay, next is the financials in a way have been somewhat a laggard since COVID. Do we see them regaining the sheen it used to have earlier?
So, well, when we say financials are losing the sheen, probably we are, drawing this conclusion looking at the stock prices. Fundamentally, financial services sector is as relevant as it was pre-COVID, during COVID, and today. The role financial services sector plays in funding the growth of economy, funding the aspirational purchases of people like you and me. The role of lenders and insurance companies and non-lending financials continue to remain, right? So, from fundamental perspective, I don't feel that the sector has lost its sheen. From price perspective, yes, and that probably is because money wants to flow to other areas. But the net result of all this is that today financial services sector, especially the lending side, is in on valuation terms one of the most reasonable sectors. Yes, there are growth challenges. The bottom line growth for next 1.5 year is likely to be low double-digit number. And people are finding better growth rates in other sectors, and hence money is moving there. Even within financials, when we look at non-lending financials, we just saw the kind of bottom line growth wealth managers, RTAs, and asset management companies have reported, right? So money wants to move there. When the interest rate cycle will stabilize, and uh, when money wants to move back to lending segment because of the valuation, probably that is when the relevance will also be seen in case of price performance, not only fundamentals.
Okay, although you have covered the data in your slides, question is regarding the recent data shows deposit growth being fast than the credit growth. Credit growth being faster than the deposit growth. Any reason why that's happening and is it sustainable?
So there are a lot of structural issues behind deposit growth lagging the credit growth. One is out of all the income that gets generated by households, one, because of rising retail credit, a lot of that income is spent on paying EMIs, leaving lesser amount of savings per household. Within whatever is left after paying EMI, a lot of money is going into equities, whether it is investment in cash or derivatives, and as a result, much lesser amount of money is left for banks to compete for deposits. Because at end of the day, it is about what kind of returns one is getting from deposits versus other revenues, right? The other avenues today are generating better returns, and as a result, people want to keep less and less money in deposits, which is leading to a situation where, while there is pretty healthy credit demand, the deposit growth continues to lag the credit growth. And as a response, essentially, banks too have seen moderation in credit growth because of the regulations governing the sector. You cannot infinitely grow credit growth at higher rate than deposit growth. The reserve requirements, and the liquidity situation will force the sector to bring down the credit growth if deposit growth continues to remain weak, which is what we have seen in this quarter as well.
Okay, what are the recent additions to the portfolio and your view in particular on CDSL? Stock has already made new lifetime high. What is your take on the stock going ahead?
Okay. So most recent addition we have done is the CMS Info Systems and CAMS. We already held KFin Technologies, which is a mutual fund RTA. We decided to add another such story in form of CAMS. CAMS, I'm sure all of you know, is essentially offering services to the mutual fund sector. While KFin has a lot of focus on developing their presence in a lot of East Asian countries and offering services like MFRTA and related services in Malaysia, Thailand, Indonesia, and all those geographies. The CAMS is developing strengths domestically in addition to the MF business, where it has about 70% market share. It is developing strengths in account aggregator, payment aggregation business, insurance repository, and use of AI in credit underwriting, and use of account aggregator in link with AI for lenders in India. So that's the reason why we decided to enter CAMS as well. On CMS Info Systems, it is a pure business service company, largely dealing with cash logistic as a traditional business. This is the entity you see on the vans, which is replenishing cash in ATMs. So besides providing the cash logistics, they also offer full packet of services, which includes setting up of ATM for banks, managing the ATM and everything, full fledged services. In addition to this strength, they are getting into newer businesses like remote business monitoring, brown label ATMs. And so essentially all the new businesses that we are talking about are somewhere connected with the same set of clients, so to say at this point. And all these new lines have significant potential um, uh, for the business in long term. And as a result, we decided to build position there. On CDSL, well, the pace at which the country continues to open demat accounts remains pretty healthy. We should make a distinction between CDSL and, let's say, other capital market plays, in the sense that CDSL's business is primarily connected with cash market activity, whereas the business model of other entities, let's say like Angel One, uh, exchanges like BSE, they are more driven by the F&O volumes. So we have a good balance of cash and F&O volume businesses within our FOP portfolio, as we have presence on both equity F&O side as well as equity cash side. And this is a business which generates its income from cash related activities, as well as earns a lot of income from corporates because of the fact that retail participation has increased. More and more folios are getting created, and that is where CDSL generates its revenues from. The growth aspect, because of the fact that more and more companies are coming up for listing, they also form client of CDSL, and this growth story continues to remain pretty attractive. Uh, I hope that covers the CDSL bit as well.
Yeah. So Bhavesh, next question is regarding Bajaj Finance and Bajaj Finserv, as these stocks are underperforming for a long period of time now and constitute around 10% of the portfolio combined.
Correct. So yeah, I mean, there has been underperformance naturally, and as a result, we have lowered the weight in Bajaj twins from 30 odd percent to 10% today. Incrementally, if you look at valuations today, Bajaj Finance would be trading at similar valuation that SBI card trades at. That is at around 4 times. In terms of PE, it is trading at around 19-20 times, which when compared with its earnings growth potential is pretty reasonable, because we expect earnings growth to be around 20-21% for current year as well as next year. So there is a sense that while the stock has underperformed in recent times, incrementally, given the current valuation where it is, trading closer to a P which is similar to the earnings growth, the risk of further multiple derating appears to be limited at this point. And as a result, we continue to hold. In fact, we have added a little weight there this month itself, owing to what we just discussed.
Okay. Next question is regarding PSU. How are you taking PSU as a segment at this current juncture, especially REC in the portfolio, which has a good run up recently?
Yeah. So, as we have highlighted earlier, we have no specific grudge against PSUs, and we have taken position in PSU banks or NBFCs as in when we developed comfort over sustainability of growth and ROE. Same was true for REC. In case of REC, the loan growth continues to remain very robust, and as we were discussing, the NIM for REC has actually improved in last 1 year, and as a result, financial performance has been pretty impressive. From here on, in terms of performance of stock, even after this rally, today REC would be trading at around 1.6, 1.7 times FY26 book value, which is not necessarily very expensive given the fact that they have been churning ROE of around 19-20%. And so there is possibility of some bit of valuation re-rating in addition to a 17-18% kind of bottom line growth. So that's a good proposition in my mind.
I would still request participant, in case they have questions, they can type in their questions and queries related to the portfolio, and we shall try to get them answered. So there are no more questions. We would like to thank everyone for the kind attention and participation in ASK Financial Opportunities Portfolios quarterly update call. Thanks, Bhavesh, for sharing the quarterly update.
Thank you. Thank you, everyone, for patient hearing. Feel free to reach out to me through any of our team members for any further queries. Good day, everyone.
Thank you. Thank you all. This concludes our call. Thanks all once again.